Are you considering retiring soon? Are you running into terminology that has you confused? Today, we're going to go over 10 terms that all retirees should know. Hi, I'm Garrett Ray, financial planner here at the Wealth Guardians in the Ray Financial Group.
And I'm Brice Payne, and you've entered The Vault, the Wealth Guardians video series on all things regarding retirement planning. In this episode, we're going to talk about terms and acronyms that you might know but don't know what they actually are. We're going to talk about 401ks and other employer-sponsored plans, whether they are defined contribution plans or defined benefit plans. We're going to talk about annuities and, mutual funds and exchange-traded funds, anything that is out there that is a term that you've heard of but might not know what it means. Don't forget to hit these like and subscribe buttons down below here if you want to catch future episodes of The Vault with Doug, Garrett, and myself. Okay, Garrett, let's go ahead and get started on this episode here. Let's start off with something easy.
Okay.
401ks.
Yeah, the 401k. Easily the most popular employer-sponsored retirement plan. Essentially with a traditional 401k, here's the things that we absolutely love about it. You get to contribute a portion of your paycheck, out of sight, out of mind, every time you get paid, whether that's every other week or once per month. A portion of that of your paycheck is going in pre-tax dollars into this retirement account for your future. Things that are great about 401ks, they typically have a relatively high contribution amount. Going into 2024 as we are here, the limits for 2024 are going to be $23,000 per year if you're under age 50. And if you're age 50, that goes all the way up to $30,500 that you can contribute with a tax deduction. So what does that mean? Essentially, as you contribute every step of the way throughout the year, at the end of the year, when you file for taxes, you get to subtract the amount of contributions that you made towards your retirement plan, or in this case, a 401k, from your taxable income. So we love it for all those reasons.
All right, very good. Yeah, I think most of us are familiar with 401ks, but it's always good to have a little bit of a description or definition of what they actually are. Let's talk, Garrett, about one of the terms that might come up in a 401k, matching contribution.
Yes, the matching contribution. So again, this is employer dependent. So not all companies do this, but this is something that you definitely want to know. There are companies out there that will match your contribution up to a certain amount. So how is this typically defined? Let's take, for example, a company that says, okay, we will contribute 100% up to 3% of your salary. So that means that if you, the investor, contribute 3% of your salary into this plan, they're going to give you another 3% on top, effectively giving you 6% of your total salary each and every year going into that 401k or that employer plan. So how does that break down? Let's say you had a salary of $50,000 and your employer says we're going to contribute 100% up to 3% of your salary. Well, if you had done that, then your employer over the course of the year would contribute an additional $1,500 that you wouldn't have already had. So for you contributing your piece, you're going to get that additional piece from your employer. It's a great thing to know. Number one, does my company offer a match? And if they do, what are the terms? We're just using 3% as an example because it's a common one. We've seen employers that contribute up to 4, 5, even 6 to 8%. So ask your benefits specialist at your employer, what is the matching contribution if they offer a match? A
broad rule would be, hey, I want to at least contribute to my 401k up to that match, because most of the time, perhaps this isn't a universal rule, an employer isn't going to offer that match if you're not contributing to the 401k yourself. That's why they call it a match. So if you're not contributing to your 401k and your employer was willing to contribute up to 3% of your salary, that's just 3% of your salary that you're willing to say to your employer, thanks, I don't want that. You don't have to pay me that. We don't generally want to do that. So at least contribute up to the portion that you can, as long as it's not putting you in a financial situation, financial straits, but contribute that if you can so that you're getting that additional 3, 4, 5, 6% of the salary that your employer says, hey, we're willing to pay you this.
Absolutely.
All right, Garrett, that covers matching contribution. Let's talk about another term out there that confuses a lot of people, and I suppose this is a word or a term that its reputation precedes it, annuities.
Yep. So an annuity is something that typically most people don't think about until they start to get close to their retirement years, and they may be thinking, what the heck is an annuity? An annuity is essentially this. It's a contract with an insurance company. And essentially what they're offering is, in exchange for a one-time large payment, or perhaps a series of a couple of different payments, what they're offering is, in exchange for those payments or that one-time large payment, what they're promising you is an income stream for either a defined number of years in your retirement or potentially all the way for life. And the purpose of it is, effectively, most people are aware of, in retirement, they're going to have Social Security, which provides them a stream of income. For many people, though, this doesn't bridge the entire gap. They're looking at their Social Security benefit and they're saying, you know, this isn't really as much as I thought it would be. What's another way I can get an income stream in retirement, because I no longer have a job, I no longer have a salary? Well, an annuity is a way that you could consider doing that. Again, just a little bit of a disclaimer here. Annuity contracts can be complex. There's also tons of different types of annuities. There's fixed annuities, variable annuities, immediate annuities,
fixed index annuities,
so there's
deferred annuities,
all different types of annuities. Make sure if you're considering an annuity, talk to your financial planner, make sure it's the right fit for you. But at the end of the day, what it's designed to do is to provide you an income stream in the future once you're already retired and you no longer have the paycheck.
Yeah, for example, Social Security is technically an annuity. You've paid into it over the years, and all those payments now go into a lifetime income for you that you can't outlive. So even if you live to be 120 years old, you're still going to get those monthly payments. That's generally what an annuity is. It's an investment vehicle. Think of life insurance as you buy life insurance to offset the risk of you passing away too soon. You buy an annuity or invest in an annuity to offset the risk of you perhaps living too long. Right. So if you're going to live to be 120 years old, having guaranteed income for the rest of your life would probably have been a decent investment, rather than just having invested what would have been those premium payments into something that you're eventually going to have to tap into the principal of those accounts for. So it can work for you as long as you're going to live long enough, if you do indeed annuitize the annuity. Not all annuities have to be annuitized, but that's a whole different episode right there. All right, Garrett, let's move on now and talk about defined benefit plan. We talked about 401ks earlier, and let's talk now about defined benefit plan, a little bit different than a 401k.
So a defined benefit plan, the most common one that most people have probably heard of, is a pension. So essentially, it's an employer-sponsored retirement plan that provides workers with a guaranteed monthly income in retirement. There are some executive plans out there, like a deferred comp plan, but most commonly people are going to run into a pension. I will say, though, pensions are becoming increasingly more and more rare. Why? Essentially, there's a level of risk assumed by the employer themselves when funding and managing all of these investments. So if you have a defined benefit plan, such as a pension, make sure that you understand what your benefit is. Lots of them have different filing options. So if you started your plan at age 60 versus 62 versus 64, the income stream that you can be promised is going to likely change depending on when you file for it. Just make sure you know what your options are, and then obviously make sure that you're considering your filing strategy with your financial planner.
All right, very good. Another term that somebody might hear out there and need clarification on is early withdrawal penalty. What does that apply to, and what does it mean?
Yep, so an early withdrawal penalty typically comes into account when you have an employer-sponsored plan, such as a 401k, even an IRA, if you've done some investing on yourself through an IRA. But effectively, the IRS says, okay, we have these things set up that are retirement accounts. We know they're retirement accounts. Really, when are you starting to get to what's considered a retirement age? And the IRS, in their infinite wisdom, has defined 59 and a half or later is when you can access those accounts without penalty. Let's say, though, you enter a period of time where you're a little bit cash-strapped, and you say, you know what, I've got a chunk of money over here sitting in this retirement account. Why can't I access that? Well, technically you can, but you're going to pay an early withdrawal penalty if you're less than the age of 59 and a half.
Right.
There are a few exceptions to this, one of them being the first-time home buyer exemption, which can be a good deal. If you've got like a 401k, let's say you've worked through your 20s, you got a little 401k set up, and you're considering buying your first-time home in your late 20s, early 30s, okay, that's one exception. For the most part, though, exceptions are few and far between, and so you're going to pay a 10% penalty just for simply accessing the money before you're 59 and a half. So let's say you took $10,000 out of your 401k and you're like age 40, you guessed it, you're going to be hit with $1,000 just right off the top penalty.
Throwing it away.
Yep. So generally we try to avoid those, but you need to at least know what they are.
Right. And so one way, if you have an employer-sponsored plan, we talked about taking an early distribution from that. Most retirement plans, not all, offer you the ability to take a loan out from it. So even if you're under the age of 59 and a half, you might have the ability to say, take that $10,000 that you needed to, for the first-time home purchase or whatever, to take it out of that, and then you repay back the loan plus the interest to yourself. So you're not really paying interest to a third party. You're paying it back yourself. So it's one way to get around a early withdrawal penalty if you have that option available to you.
Yep.
All right, Garrett, let's move on next and talk about two different types of investment options. One is a mutual fund and one is an exchange-traded fund. I think more people are familiar with mutual funds. We'll talk about that in a moment. Let's start off with exchange-traded funds. What are these things?
Yeah, so an exchange-traded fund, or an ETF, may be the terminology that you've heard of, or the acronym. Essentially what an ETF is, it looks a lot like a mutual fund in that it's an investment that pools money from different investors. But what an ETF aims to invest in mostly is typically different market indexes. So think about the S&P 500, perhaps the Russell 2000, a mid-cap index, something like that. And essentially what the ETF is saying is that it's an investment that tries to mirror the performance of that index. So let's say, for example, you're inside of an S&P 500 ETF, or an exchange-traded fund. And over the course of the next year, the S&P 500 goes up 7%. Well, that ETF tries to mirror that benchmark, and it should be up at about 7% as well. So slightly different than a mutual fund. We'll get to mutual funds here in a second and how they differ. But an ETF, just know that it's investing in different market indexes, and it's trying to mirror that benchmark performance.
Generally speaking, exchange-traded funds have very low fees to be in them, and there's not a lot of trading going on inside exchange-traded funds. Just like you see the S&P 500 at the beginning of the year compared to the end of the year might very well have the same 500 companies in it. So an exchange-traded fund that is mirroring the S&P 500 might not have any trading in it throughout the entire year, or very little trading. So that's two features of an exchange-traded fund. Now, Garrett, let's compare those to mutual funds. Kind of similar as how they look, but inside and how they work a little bit different.
Yep, mutual funds. So most people are familiar with these largely because they're often available inside of 401ks. Inside of a mutual fund, it's like an ETF where money is being pooled from different investors. This time, though, inside of a mutual fund, it's going into typically a sector of the economy. Let's say like you're invested in an energy mutual fund, or you're inside of a pharmaceutical mutual fund, that sort of thing. And it's professionally managed. There's a mutual fund manager, perhaps a team of managers. They've often got a team of analysts. And what they're trying to do is trade inside that sector of the economy, not only to hopefully match the benchmark of that sector of the economy, but ideally to beat it and to get the investor a little bit higher rate of return. Now, there's a trade-off, though. You are going to pay higher fees inside of a mutual fund than an ETF most of the time. What are you paying for? Well, you're paying for that mutual fund manager and his or her team of analysts to help invest on your behalf. Mutual funds are a way to get the passive investor or the average investor some level of professional management over their money. That's the benefit of them. The potential downside could be higher fees and, like you talked about, Brice, higher transaction costs.
Right.
So they typically trade a lot more often than ETFs. And you had a good point that we were talking about off camera. If you're going to be trading a lot inside of an investment, then perhaps you align your mutual funds inside of your IRAs or your 401ks, where you're not having to pay any sort of tax gains or losses on the trading transaction itself. If it's in a brokerage account or a non-qualified account, now that could open up the various trades to long-term or short-term capital gains.
Yeah, if you had, let's say you had both mutual funds and exchange-traded funds in your portfolio, one would generally think that they would put the exchange-traded funds in a non-qualified account and the mutual funds inside an IRA or a Roth, because there's different tax treatments on how often they are traded. So just something to consider. All right, Garrett, let's talk about one of the most popular acronyms out there, IRAs, which everyone thinks stands for Individual Retirement Account, but it actually stands for Individual Retirement Arrangement.
Yep.
All right, so what is this? What is an IRA?
So an IRA is essentially, it is you, an individual, entering an agreement or an arrangement with the IRS saying that I want to, as an individual, invest on retirement on my own behalf. How does it differ from an employer-sponsored plan such as a 401k? In that an IRA, you have access to the entire spectrum of the market available to you. So you can invest in sort of bonds, you can invest in precious metals, you can invest in individual stocks, mutual funds, you name it. They do have contribution limits, much less than a traditional 401k. Going, at least right now, in 2023, the contribution limit is $6,500 for those of us who are below age 50. If you're age 50 or older, you get an additional $1,000, $7,500. And it works, if it's a traditional IRA anyway, much like a 401k. You make that contribution, let's say it's $6,500. When you file taxes at the end of the year, you get to subtract that $6,500 from your taxable income. So it's a way for the individual investor to invest for their future inside of retirement.
And it's basically a registration of an account. You can have Roth accounts, that's the registration of the account. You can have an individual account, you can have an IRA, 401k, you can have a SEP IRA. There's a lot of different registrations of the accounts, and that registration is basically just telling the IRS how they can and cannot tax the growth of the investments inside it. Absolutely. So if you're willing to put money aside that you know that you're not going to use until you're 59 and a half or older, and you want a tax benefit in the year that you make that contribution, an IRA could very well be the investment vehicle for you. And then, of course, you have the choice of the investments that actually go inside that IRA. I think for a lot of people, it gets confusing of separating the concept of what is the registration of the account and what is the investment inside the account. It's not uncommon that I'll get somebody to ask me, hey, how much are IRAs growing these days? Well, the IRA doesn't grow. It's the investment inside the IRA that grows. I could have an IRA that is just all in cash, not going to grow at all. I could have an IRA that is in cryptocurrency. Might grow really much one day and go down significantly the next day. So separate the concept of what the investment is and what the registration of the account is basically what we want to make sure you understand. All right, Garrett, let's do one more here, and probably one of the more common acronyms out there, RMD, Required Minimum Distributions. A lot of people have heard of this. A lot of people dread them. They know they're out there on the horizon at some point. The magical year right now is 73.
73, right. So required minimum distribution. So let's do a quick recap of what we like about the traditional 401k, traditional IRA. We like it in that you can contribute for your own retirement later in life. Particularly inside of a 401k, you get pretty high contribution limits. And then when you file taxes at the end of the year, you get to subtract that off of your taxable income. We like that, right?
Right.
Well, there is no free lunch for forever. And so what that means is, as Brice said, once one turns 73, even if you didn't want to touch the money,
didn't need to,
the IRS is going to force you to take a distribution out of that account. And what about traditional accounts do we know? Every time we take a distribution from it, we have to count that as income, which is, of course, taxable. So, like Brice had mentioned, the current law says that right now the magic age is 73. Once we reach 73 or older, then we have to go through a calculation that the IRS helps us do that basically says this is how much out of the account they are forcing you to take, and then, of course, that will then be taxable. So there is no real way around it if you have money inside of a traditional 401k IRA once you hit 73. The only way you could get around it would be converting that traditional money into a Roth designation. That's a little bit more of a complicated subject for a later time. Roths don't have RMDs as currently structured unless you inherited them, then they do. Again, another subject, but that's the concept of the RMD, is that eventually there is no free lunch, and at age 73, the IRS says, okay, the gig is up. Now we're going to force you to take at least a portion of that account out and claim it as income.
Yeah, and sometimes people will ask me, well, how much do I have to take out of my IRA or my my qualified or pre-tax accounts when I turn that 73? The number is going to constantly change, but right now it's somewhere around, divide that account by 26. When you turn 73, if you divide that account by 26, let's say you've got $1 million in your IRAs, well, divide that $1 million by 26, and that's what you're going to more or less have to take out in year one of your R&D years. Now, I've got a client right now who is saved close to $3 million in IRAs. And in their peak RMD years, they're going to be having to take out around $500,000 a year from their accounts. They're going to get plenty from Social Security and some other forms of income. They really don't want to take any of their IRA monies out,
Right.
but the government's going to force them to. Think of having to take $500,000 out of your retirement account and pay taxes on that in a year that you didn't want to take any of those monies out.
Right.
So there is definitely a drawback to having too much money in IRAs. There are some other options as you move into retirement to try to quell your RMD consequences moving forward, going on when you turn 73. A good financial planner would talk to you and help you plan to mitigate your RMD risk that you have going on in the future.
Absolutely.
All right, Garrett, we just covered 10 different phrases or acronyms there that people should be aware of as they go into retirement. Anything else we want to cover?
I think that's a good list for now, Brice.
All right, very good. That's going to wrap it up for this episode of The Vault. Again, I'm going to draw your attention to these little like and subscribe buttons down below the screen there. You can click on those, become members of The Vault with Doug, Garrett, and myself, and catch all future episodes without having to go search for them. I'm Brice Payne.
And I'm Garrett Ray.
Don't forget, financial plans do not create themselves. This has been The Vault.